Good morning, everyone. We're going to get started. Thanks for joining us here in person in downtown Los Angeles, and thanks for joining us online for a session that OIC is presenting. Another one of our educational simulcast sessions today. Going to be talking all about Greeks and options chains. Some people may say this is one of the more advanced topics that you'll get into the options space. I really don't think of it that way. I think the Greeks are very simple to understand. It's just a matter of terminology and understanding how to translate Greeks into your position analytics and how it affects pricing. But we're going to try and demystify, if nothing else, the definitions of Greeks. And then also, we're not just going to run through definitions. We'll come up with examples along the way and have knowledge check and quizzes to make things a little more interesting and see how you can implement what you've learned here today. My name is Ed Modla. I am the Director of Retail Education at the Options Industry Council. Got my start in the business back in 1997 on the trading floors in Chicago. After graduating with my degree in finance, I went straight to the trading floor, Chicago Board Options Exchange. I learned market making and professional trading from the pros at Blair Hull Trading, one of the largest market making firms in the business at the time. I worked on the Mercantile Exchange and then also at the Amex Exchange in New York City. The training was intense when I began in the business. Every single day, an hour of classroom in the morning, from bell to bell on the trading floor, and then an hour of classroom after the trading day, every day for a full year before I ever traded an options contract. 22 years later, I'm still in the business. I've moved around a few different times, traded for firms, traded independently. I worked as a broker in the futures industry, but now I love what I'm doing on the service and on the education side. Pleased to be joined today by Jamal Chandler, who's an instructor at SIBO Options Institute. Bring him up in a second. He's going to get us started with the educational part. I'm going to do the intro here. First session today on Delta and Gamma. Here is our disclaimer. Options are not suitable for everyone. They're a complex investment tool. It does take some discipline and study and a deep knowledge of the product before you use them in a live account. OIC was founded in 1992 as an industry cooperative. The objective was to provide unbiased, free education to the public on the listed options product. The exchanges got together at that time, and the brokers from the entire industry got together and realized there were some myths and misconceptions about the options product. And rather than all of the education coming from entities that want to sell you something, the industry wanted an unbiased, free source of education that strictly had an objective on communicating the benefits and risks of the product. We don't sell anything. We're a nonprofit industry cooperative. You can find us at optionseducation.org. Got plenty of material there, written podcasts, videos. You can also reach out to our investor services team. They are available by email at options@theocc.com. They'll answer your email questions about what we offer and the options product. For those of you online, also type in your questions in the Q&A box. The investor services team, which is managed by Mark Benziquin, they are behind the scenes online, and they will be answering your questions as you type them in as we go through the presentation today. A little bit about the exchanges. This is where all of the execution takes place. When you send in an order through your brokerage platform, it gets accepted and worked at the exchange level. I think we all know this. And when you execute a transaction, that occurs on one of the exchanges. But a few other things that you might not be totally familiar with. Of course, not every options contract or not every company has listed options contracts. You might be wondering, where does that come from? How is that decision made? Each of these exchanges makes an independent decision on whether or not they're going to list options on a particular company. Each exchange has minimum requirements that they're bounded by. For example, a stock has to be trading at least $3 a share. It needs to be on a national exchange. It needs to have at least, I believe, 2,000 shareholders and 7 million shares in float. Those are minimum criteria. And then once it meets those criteria, the exchanges can decide for themselves what they would like to do as far as listing options. Back in the day, many, many years ago, if options were listed, they were only listed on one exchange. Now they're likely to be listed across multiple, if not all, of the exchanges. Everyone in the industry has an interest in seeing volume grow. That's what we see here on the chart. We're about to put up 2019 numbers, which is not going to be quite as high as 2018. We set a record last year with some elevated volatility, but you can just see the growth in the industry as do-it-yourself investing and knowledge of the product came to the forefront at the turn of the century. 2011, I always like to point that out. You had a spike there in 2011. For those of you who were in the market 8 years ago, you might remember the European sovereign debt crisis going on throughout that year. Elevated levels of volatility that is good for options volume. We had a spike there. But really, just as impressive as that was the subsequent years from 2012 through 17 with very little volatility in the marketplace, historically low, with volatility in VIX trading below its long-term average for months. I believe it was 2016 or 17. The entire year went by and the VIX never closed above its long-term average. We were still seeing heightened levels of options volume. Set a record last year, and this year we'll be coming close to that, hopefully. Here's the presentation outline for session number 1. It's going to be Greeks. Delta and gamma is what we're going to isolate on in this first session. And I'm going to bring Jamal up here in a second. Greeks really are just a way to forecast, analyze, and understand what's happening with the price of an options contract. And as I said earlier, I want to demystify what the Greeks are because I believe they are not an advanced topic, that you are likely doing some form of Greek analysis, whether you know it or not. If you're trading options and you're evaluating, is this an expensive price? Is it cheap? Do I think I want to pay this amount for the risk involved? Whether you know it or not, you're doing a Greek analysis. And we're going to start to not just define the Greeks, but get into a few examples of the Greeks. I said test your knowledge, and then along the way, tie the Greeks together so you can see how they work together. And at the end of the day, if this is new to you, I'm sure you'll come away with a good understanding of what the Greeks are, and if you're already familiar with the Greeks, hopefully we can give you some interesting commentary along the way. So to get us started, I want to bring my colleague, a good friend of OIC from SIBO Options Institute, Jamal Chandler, who's going to get us started talking about Greeks first and then Delta.
We're going to have fun here today, okay? Wanted to show you some good stuff. We're going to sort of demystify the Greeks, just like Ed said. To give you a little bit of background about myself, this is not an industry that I started in. So I started in material science and engineering. That was my background. I did material science and engineering as a graduate degree. I did chemistry undergrad, and then I did material science and engineering. And so I was a science and engineer for about 10 years. That's kind of what I did. I worked at a research laboratory in Madison, Wisconsin, which is Forest Products Laboratory. I worked on a lot of wood research materials where we were doing a lot of wood bonding type stuff. And that's my background. Along the way, I would get bored, and I wanted to learn more about trading. I thought that it was something that was really interesting to me. So I was trading stocks, never trading options. As a matter of fact, it's pretty funny because a friend of mine, we both signed up for the same brokerage at the same time. And when I was filling it out, I was like, what is this part about options? He's like, no, we don't want to do that. We don't want to do that yet. That's a little too advanced for us. So it's really funny because 2 years later, I get a job at an options trading firm, which is a long and winding story. But long story short, I wind up at an options trading firm, a proprietary trading firm in Chicago. And I worked there for 8 years, never even thinking that I'd worked there for 8 years. I actually thought that I'd worked there for 2 years, and then maybe after 2 years, I'd get a job in the engineering field, and that's where I'd end up. Well, it was fantastic. I started there in 2006, and just like Ed said, I had a year before I even traded any options in my own account. We had class every day. We had mock trading, which was a very humbling experience. Mock trading is basically where you learn how to trade like in the pits, like they did. And it's not easy because you're learning the essence of trading, supply and demand. You're learning how to sort of read people, read the crowd, read what's going on the stock, with the stock, what's going on the screens, learning how to trade. And it's I lost sleep over it at night because I couldn't figure it out for a lot of different reasons. And once I started to get that, once the education gets down, then the rest kind of falls into place. Because to be totally honest, once you're doing Greeks and you're learning these other background things, that's supplementary to eventually understanding how you need to control your own emotions around trading, which I think is a huge thing. So, worked at a trading firm for 8 years. I was out of the industry for about 1.5 years trading on my own. Then after that, I started back in the industry through the regulatory side. So I worked at FINRA for about 1 year. Then I started at SIBO now, Chicago Board of Options Exchange, or we're SIBO Global Markets now. We get a little complicated with our name. We actually bought the BATS Exchange, which is an all-electronic exchange, in 2017. I actually started on the day of the merger. So I've been at SIBO for 3 years now. I was in their regulatory department for 2 years, and then eventually I started back in this, or I should say I came into this role, which is more educational, which to echo Ed's sentiments, I really love this role because you get to talk to people and explain a lot of the option stuff, demystify it, break it down. I'll tell you when it's hard and hard to understand, and I'll also tell you, like, you can get this and this is pretty easy. So, with that being said, what are the Greeks? Well, in general, when you have pricing models, the pricing models will generate like theoretical values for your options, okay? And so the Greeks are the ways to sort of understand what's going on with your positions, whether it's one position or 10. And I think one of the best things about it is that when you have more positions, you'll start to really see how the Greeks work. But it's best to first work with one position. When you have one position, you'll see what's going on with your Greeks, using the Greeks to understand how you may or may not be making money. That's probably the best way to define it. So when you have a dynamic marketplace, the conditions will change, right? Volatility will go up and down in our marketplace. The stocks, or whether it's the actual, whether it's the actual index, will go up and down, and they'll move in various different ways. And we've already, from what you've maybe understood so far about options, you can either have, calls or puts as far as just from the buy side. You can make money in several different directions, or you can make money when things aren't happening. And so to be able to help you understand that, that's why Greeks sort of exist. So like we said, the stock prices will change, volatility will change, as time goes by, your options will decay, right? So option prices are sensitive to these changes, and these models will kind of help you predict and understand what's going on with your positions. So there's sort of these like tools, and they're like help you understand where your risk lies, if you can understand it in that way. You have risks, and so in the several different areas you may have risks, and the Greeks will help you understand where your risks lie. The Greeks, as they lay here, it's cool enough laid out. We also got the symbols next to them for you. Delta is basically, that's the expected change in option value with the changing underlying stock price, okay? If you have delta, whether it's short or long, you should understand which way that's going to move. But either way, when your stock moves, your delta is going to change. It's as simple as that. How is it going to change? It's going to change based on your gamma. Gamma is that expected change in your option delta with the changing underlying. So when your gamma changes, it will create a change in your delta. And your delta is, the easiest way to understand delta is like if you have, say you have one share of a stock. It moves up $1, you make $1, okay? It's that simple. So with options, though, it's a little bit different in that your deltas are, there's the 100 multiple, which we'll get into a little at some point. There's that 100 multiple that goes along with whatever option delta you have. And then that will generate a number, and that will determine how much you make or lose based on the underlying change. Theta, the best way to understand theta, it's the expected change in option value with passage of time. But the best way to understand theta is that when you have an option, it will, at some point over time, decay. Okay? And with that option value, your option theta sort of determines how much you make, how much money you make, how much you are paying or collecting on a position over time. Okay? So that's the best way to understand theta. It's how your option value appreciates or declines with the passage of time, and that depends on whether you're long or short the option. Vega, as soon as you hear Vega, you should think volatility. Okay? So that is the expected change in your option value with the changing implied volatility. So when implied volatility goes up or down, depending if you're long or short the option, it'll produce a change in your Vega, and that's how you read the Vega. And then finally, rho. You usually, for the most part, most of us aren't. You're not going to see that anticipation or that change with rho. But rho is your option sensitivity to interest rates. And for the most part, we've seen a pretty low interest rate environment. Had it been, in the 80s, you'll see a big difference in the rho. One of the things when I started at a time where interest rates were declining. So like 2006 when I started, 2006, 2007. Interest rates with the Fed, they were decreasing the interest rates. And so every time you'd have a Fed day and they dropped the interest rate, your whole portfolio, depending on what type of positioning you have, would change in some type of way, in a decent sized way. You'd notice the change in rho on that day specifically. On a general day in and day out basis, you don't really see it. But it's something that you should understand and know. So if you have an option that you're trading, and let's just say you're long an option, and you see a change in volatility, that's going to affect your Vega. As the passage of time goes on, you're going to see the change in your option based on theta. You're going to see how much it decays. When you have a theta value, every day you're paying or collecting a certain amount of theta, and you're going to see that change based on that. Gamma, it determines how much your delta is going to change. Delta, you're going to know right away. As soon as your stock moves up and down, you're going to see that change within your position based on the delta that you have. So the nature of these Greeks, they are theoretical measurements. I mean, they don't guarantee you anything, right? Like, just because you have a certain Greek value doesn't mean you're going to make XYZ amount of money based on what's going on with your Greeks. It tells you what could happen in the event something affecting your Greeks does change. So that's the way you should look at it. And then each Greek isolates risk from a single pricing factor. It assumes all the other factors are unchanged. Okay? So for example, if you're considering delta, the change in the underlying stock versus the option value, that's going to assume that your volatility is kind of staying the same, time and interest rates are staying the same, right? And the biggest, one thing you should understand, of course, these Greeks only mean something as long as you have the option, right? So during that option value, during that option's lifetime. And at expiration, they're moot. Usually at expiration, well, you're either in the money or out of the money at that point. So that's the biggest, most important thing you should understand. And then, like I just said, at the impact of that Greek is the option's time value. So at expiration, your option is only worth the intrinsic value, how much it's in the money. Greeks sometimes can affect each other, right? You'll see that every now and again, like I said, with the change in that option's theta over time. That may determine your delta. So as time winds down and your option is closer to in the money, then your delta could be larger. If time winds down and your delta and your option is out of the money, that delta is probably going to be smaller because it's a little smaller out of the money, it's a little further out of the money, and you're going to need a larger move to maybe make it wind up in the money. So you'll see different ways in which your Greeks affect your, one Greek may affect another from time to time. And then the impact of Greeks differ for each option contract. If it's in the money versus at the money or out of the money, they're very different, in those different situations as we just kind of talked about. An in-the-money option will have different Greeks. Case in point, if you have an in-the-money option that's nearer to expiration, and it's completely in the money, the delta is going to be higher on that, but your gamma is little to none, and your theta at that point is kind of little to none as well. So you're not really paying as much theta on that option if it's in the money, deep in the money. And the gamma, the gamma kind of determines how much your delta is going to change. Well, if it's really far in the money, it's close to expiration, there's little to no gamma in that situation. There's also no vega. Vega is the amount of volatility, and it's usually higher and more pronounced in options that are further out in expiration. So for you guys, and individual investors, most importantly for you to understand is that your stock selection, broad market direction, outlook for your industry sectors, and your risk. These are the things that will help determine your Greeks, right? The value of your Greeks, understanding where your risk comes from overall. Like we just said, understanding that if your option is closer to being expired, you're probably going to have less vega. If it's further out in expiration, you're probably going to have a higher vega value. To give you an example, if you have a stock that's, say, $50, right? It's an at-the-money strike. So you're long a $50 call. And let's just say you have an option that's a week to expiration, and then you have an option that's 6 months to expiration. They're not going to have the same delta. It's going to be probably a little bit higher delta, depending at in the near-term value. Could have a little higher delta on the out-term. It just really depends on the situation. Let's say all else is equal. Your at-the-money option that's with a week to go, it's going to have a higher delta. It's going to have a higher theta. It's going to have a lower vega. So those are the ways you can kind of understand your risk and see where those things lie. Okay? So you want to balance your risk versus rewards when you're at the outset of creating your positions. And you want to set your expectations. Understand that, like we said, nothing is guaranteed with the Greeks. There are ways to help you determine what's going on with your positions. And it also does, I think this is a really good point right here, it helps you reduce your surprises. Every time you have an option position, every day that goes by, one of the best things you could do is look back at the end of the day when the market is closed and say, okay, why did I lose or make money in this situation? Was it because of delta? Was it because of vega? Was it because of theta? That's something that you should kind of look at every day. It's something that I know they made us do. I'm pretty sure they made you guys do too. At the end of every day, we would look at positions Okay, what's going on here? Why did we make or lose money in this position? Was it because of the stock moved? The stock didn't even move today, and I lost XYZ amount of money. Why is that? Because theta happened? Theta just came in? Was there earnings? Is that the reason why all of a sudden volatility came in? So that's what happened with my Vega? Why did I make or lose money? You should do that every day. That's a really good exercise to do. Where can you find the theoretical values in the Greeks? You can look at brokerage firm websites. There's also a quote provider here at www.optionseducation.org where you can look at these, see where the theoretical values for individual stocks are. And so let's get a little deeper when we talk about option delta. It's the value sensitivity to stock price. So when your underlying moves, your delta should move. Doesn't necessarily mean it's going to move in your favor, but it will change, right? So the expected change in an option's price, up or down, from each 1 point move in the underlying price. Deep in the money options usually have a higher deltas. They're approaching 100% or 1, depends on how you want to look at that. However you look at it, should be consistent. I know that that was something that was confusing, you know, when you're first getting into the game and somebody's asking you different deltas. What's the delta of this? You may say 0.6, 6, or 60. Whatever you decide, make it consistent so you can understand on the regular. It should be like that. You should be able to get it on the regular. At the money options, usually at 50 delta, and then far out of the money options usually are approaching closer to 0, right? So that's your tiers right there. In the money options, at the money, out of the money options. Calls are positive deltas, so when the stock moves up, your delta and your call is going to go up. Vice versa, when the stock goes down, your call price is going to go down. And that's the way you'll kind of evaluate your delta. It's anywhere from 0 to 100. So if you have at the money, it's 50. Stock price goes down that day, it's going to be less than 50, more than likely. Puts, on the other hand, have negative deltas. Like somebody I work with often says, sometimes it's hard for people to understand that stocks go down, but they do, right? And when they do, this is one of the reasons why puts sort of exist. You can have this ability to buy a put on a stock, and naturally it makes sense that the delta is negative, so that when the stock goes down, you're making money in that direction, in that negative direction. So the stock price goes up, your put price is going to go down, but when the stock price goes down, your put price goes up, right? And put values range from 0 to -1 or -100. So what's your delta as your in-the-money probability? There's another way that investors can use this delta to sort of it's another way to understand what's the chance that your option will end up in the money or not, right? So if you have a 70 delta call, one of the ways to look at that is say, oh, this call has a 70% chance of ending up in the money. It doesn't guarantee you anything, right? But it just is kind of a different way to look at it. You can also say, well, there's a 30% chance that it'll wind up out of the money. Now, that doesn't necessarily even mean that it's going to have the same value that you might have purchased it for, neither. Just because it has a 70% chance of being in the money doesn't mean it has a 70% chance of being the same value that you bought it for. Say you bought let's say a $50 stock and it's a 50 strike call. Say you bought that for $3 and then it's 70 delta and there's a 70% chance it ends up in the money. At expiration, all of a sudden the stock is trading $51. What's your option value? $51 stock, 50 strike call. What's your option value? I like the way you yelled that out, though. That's right. Don't be afraid. It's good. Anybody? 50 strike call. $1. Exactly. So you bought it for 3, and now it's 1. It still wound up in the money. You were probably right on that 70% chance, but it didn't guarantee that your option value was going to be the same, right? So that's just something to understand. So if you sell a 30 delta call, it could indicate there's a 70% chance that it's going to finish out of the money. So these are percent chances, the way to look at it. And again, in the money, out of the money doesn't equal profitability, like we just examined. You bought a $3 call, it still wound up in the money, but you lost $2 on it. So it just shows you that these are ways to look at it. This is a percent chance it may or may not end up in the money, but it doesn't mean that you're going to make money in that particular situation. And I always like to give examples of not necessarily making money, because then when you make money, it's a good bonus, right? We're going to do a little test for you here on a Saturday morning. Who's ready for it? You guys are like still half asleep. What's going on here? Come on, guys, give me a little something. Okay, so if an investor buys the 110 calls for $1, what is the expected option value if shares increase to $5 5 days later? So I'm going to work through this one with you. Okay, so you have the 110 calls. Stock is trading $100, okay, and we have 45 days to expiration. So we have shares trading 100. The investor bought the 110 call for $1. The 110 call has a call delta of 20, all right? Now, this is a very simplified example, all else equal. If the stock increases from 100 to 105 within 5 days, and you want to figure out what your delta might be, first you want to figure out what your delta might be on that, right? So 5 times that 1 delta, and you want to figure out what your option value is going to be. So 5 times the 0.2 gives you 1. So your option value is not only the dollar that you had before, but the 1 as well. So $2. Okay. So that was just all we did there was just multiply how much the stock had changed by the delta to get an idea of how much our option value would be. If an investor sells 2 of the 90 strike puts, what is the probability that the contracts will finish out of the money? So when we said earlier, you can look at deltas as the % chance that something will finish in or out of the money. If we look at the 90 strike puts, and those have a 15 delta, okay? So the % chance that those could finish in the money would be 15% chance. What is the % chance that it could finish out of the money? 85% chance, okay? So again, this is a very simplified example, just to give you an idea of how you can look at these. A lot of you will go to your screens the next day and start trading and see these numbers vary a little bit, but it still kind of gives you a baseline of how to understand. If an investor buys the 110 call spread for $3.20, what is the expected value of the spread if the shares increase $5 5 days later? So first what we have to do is figure out what's our delta for this 110 call spread. The 110 call spread, the 100 calls are 50 delta, the 110 calls are 20 delta. We're buying the 100, we're selling the 110. So right there we have a 30 delta, right? So now that we know our 30 delta, we can do similar to what we just did on the first problem. If we know that the stock is increasing $5 and our delta on this call spread is 30, how much money did that call spread make in that time period? 5 times 0.3 or 1.5. And we are adding that value to the amount of the value that the call spread already is. So that gives us a value of, we got some option traders in here, Ed. We got some option traders in here. That's what I'm talking about. So that gives you an idea of how that call spread will change. Another delta example. So with the expectation of the neutral market and the desire to generate income, an investor executes an iron condor. Raise your hand if you know what an iron condor is. Okay, good. Just wondered. So an iron condor is a 4-leg spread, typically where you're selling option values. So in this case, and I think a lot of times people kind of complicate this spread. It's a 4-leg spread, but the best way to look at it, it's a call spread that you sold and a put spread that you sell. So it's just like a 2-leg spread, really. So an iron condor, you're trading that by selling the 80-90 put spread. So that means you're selling the 90 put, buying the 80 put as a downside protection, and then you are selling the 110-120 call spread. So that means you're selling the 110, buying the 120. So first, let's figure out what's the delta of that call spread. Any guesses here? What do you think about it for a second?
30 for the iron condor.
Close. See that? So the, just with the call spread alone, you see that we had the 110-120 call spread, right? Sold the 20, sold the 110, bought the 120. So that's short 15, okay? So what's the delta of our put spread? Now that we know that. Again, in the put spread, we're selling that put spread, so we're selling the 90, buying the 80. So total overall for your iron condor, what you're doing is 0, okay? Because you have the short 15 on the call spread, and you have the long 15 on the put spread, okay? And remember, when you sell a put, that's long deltas. When you buy, so we sold the 90 put, and we bought the 80 put. So in that, we have the long 15 deltas, and with the call spread, we sold the 110, which is the higher delta, and we bought the 120. So that's the short 15. So net 0 deltas overall for this iron condor. What's one of the reasons why people like to do it. It's not necessarily directional, but it's more sensitive to the idea of the stock moving around or something like that, which we'll get into in a second. So 30 days later, stock rises, and it's beginning to test the short call spread. What is the delta of that call spread now? Again, we're talking about the 110-120 call spread. If you sold the 110 and you buy the 120, Negative 35, correct. Short 35 deltas on that call spread. The stock has moved against us in that sort of way. We're short that call spread, and so our deltas got shorter. So in that's kind of an ill-adverse effect that we don't necessarily want in that spread. What's the delta of your put spread now? 0, right? So overall, our position is short 35 for that call spread, so that iron condor, excuse me, and a lot of that delta is coming from the call spread. So what can you do in this situation to sort of mitigate your risk and manage that position? Well, you could close out your put spread and roll it to the situation where you can get a little more delta, so that'll offset your short delta. When you're rolling, if you roll the put spread and you still have another short put spread, so say you roll it and sell the 100 put and you buy the 90 put, then you have short 10 deltas and you'll offset that sum and your overall position will be short 25 now, right? So that's one way to sort of help your position out. You could also close and roll out your short call spread. If you don't want those short deltas, you can sort of move that out further. Say you close that 110, 120 call spread and you end up selling like a 120, 130 call spread so that your deltas are not as short. Or you could just close the whole thing and reassess your whole situation. So with that, I hand it back over to Ed.
Gamma. I'm going to spend the rest of this first session talking about gamma, and I think I'm going to need all the time. So if you have questions, if you're really stuck, you want to raise your hand, go ahead. Otherwise, when we're done, you can come up and talk to us up here. Just to recap, what is delta? It's an estimation of how much the option value is going to change as the stock moves. That might be important to you, whether you're buying or selling options. You think the stock's going to move somewhere, or you hope it doesn't. But either way, if it does move, how does that affect my position? The delta lets you forecast that. And again, repeating the words out of Jamal when he said many times, these estimates, these Greek values, assume all other factors remain constant. That is never the case. In the examples that we're walking through, with the stock maybe moving up $5, that delta is going to keep changing. Not just with every dollar, but every half dollar, every quarter. That delta keeps changing. So we're looking at these examples so we can understand the concepts. But in reality, the changes in the option value are going to be more dynamic than that. So we know what delta is. We have a good grasp on what it is. What I just said, delta changes as the stock moves. So how much is it going to change as the stock moves? If the stock moves $1 and the delta was 20, well, what's the new delta going to be? Well, that's what gamma tells us. Gamma is known as the acceleration of delta. What is the anticipated change in delta given a $1 move in the underlying stock? It's the adjustment and the changes to delta only found in options. And again, it only assumes that all other pricing factors remain constant. If you ask a professional trader what's the most important Greek, I get this question quite a bit from investors. All the Greeks are important. They all have their value. But if you ask a professional, they may say gamma is the most important Greek. There's more information in the gamma than anything else. And I'll try and explain that as I walk through our definition. First, gamma for calls. Now, if there's a positive correlation in the change of gamma, then it's known as having positive gamma. For calls, as the stock price moves higher, the delta is going to keep going higher. This makes sense. If the option's out of the money and it moves in the money, the delta has become greater. It's moved from 40 to 60 or 30 to 70. So positive move in the stock moving higher means positive move in the gamma amount. That's positive. If the stock price moves down, the delta goes down by the gamma amount. And then it's the opposite for puts. What I want to outline here is if you actually trade a position, what gamma do you have? And there is a such thing as gamma risk. So if you were to purchase a call option, you own a call option, you're long delta. That's where you're starting out. You own deltas and you're long delta. As the stock moves up, the position you have becomes longer delta. The delta increases. There's a positive correlation there. So stay with me as I walk through all 4 of the outright options positions. Long a call option is positive gamma because there's a positive correlation in that change. Stock moving up, delta's moving up. If you're short a call option, if you've sold a call option, that's a short delta trade, correct? You sold an option, whether it's a 50 delta, whatever it is, you're short deltas. As the stock moves higher, your position gets shorter. Does everyone understand that? As the option increases its delta, your position of short call gets shorter. That's an opposite correlation. Stock moving up, our position gets shorter. Opposite correlation is negative gamma. So long call, positive gamma. Short call, negative gamma. Now let's look at puts. Might take a second more to think through the put side. If you buy a put option, you own a put option, you own short deltas. We all on that page so far? We own short deltas. If the stock drops, the delta of the option increases and we get more short. The short position we have increases. I see people nodding their heads. You're getting this. Stock moves down, we get shorter. So lower move in the stock, shorter position. That's positive correlation. That's long gamma. So again, long a call option is long gamma. Short a call option is short gamma. Long a put option is long gamma. What do you think short a put option is going to be? I heard everyone say short. Yes, it's going to happen. It's going to change in the opposite direction. If we're short a put, we sell a put outright. That is a long delta trade. And as the stock moves down, it's going to move in the opposite direction. It will get longer. So we have buying options is long gamma. Selling options is short gamma. You can keep that in your mind. And that's one reason why a professional trader may say gamma begins to be one of the most important Greeks, if not the most important one. A long gamma position tells you, I'm buying options. I'm long options. That also leads you to think you have theta risk. If you're long options, you have theta risk. If you're long options, you also know you're probably long implied volatility. This isn't necessarily the case. There could be exceptions. But just knowing that you're long gamma tells you I'm probably got theta risk and I'm probably long implied volatility. I also know where my deltas are headed. I don't know where they're at today, but if I know my gamma, I know where my deltas are going to be as the stock moves. And I also have a very good idea of what my vega and theta positions are. That's a lot of information just from gamma, and it's why professionals treat gamma with such sensitivity. Now, I want to look at gamma versus time, and gamma as the stock price moves. The greatest gamma is going to be for your at-the-money options. Now, if I asked that question in a general, as a general question to you, you might not know this intuitively. So I'll share something with you. When I started to learn options in the late 90s, I was being trained by senior traders and mentors at various firms. And one of the things they would do for us whenever we were in a class is they would use the phrase, push the example to an extreme. They would pose a question to us. For example, is gamma greatest at the money or out of the money? And just as a general question, you might not know what the answer was. And as we were sitting there thinking about it, no one had any answers, it was a quiet room, they'd say, push it to an extreme. Think about it again at an extreme level, and then the answer becomes obvious. Now think about what gamma is. It's the change in deltas. And I'm going to go through hypothetical examples as I flip through these slides. Say the stock's trading at 100. And let's compare two different call options. The call strike of 200 and the call strike of 100. The 200 strike is far, far, far out of the money. That delta is probably 0. If the stock goes from 100 to 101, do we think the delta is going to change very much?
Yeah.
No. No, that's nowhere near enough of a move to have any effect on what the delta is going to be. So that far out of the money option, we don't expect much of a delta change at all as the stock moves. But think about the 100 strike, the at the money strike. If the stock moves from 100 to 101, you better believe that delta is going to change from 50 to 51 or 52 or something else, depending on how close it is to expiration. So certainly that delta is going to move. That's very simple to understand. That's intuitive. And so now you know that at the money options have the greatest gamma and the greatest sensitivity to changes in delta. That's what that top chart shows, gamma versus stock price. Assuming the stock's at 60, you have the greatest gamma for that at-the-money position. Now let's look at the bottom, isolating the at-the-money calls, starting out with the stock at 60. That strike price is going to have about a 50 delta, and as the stock moves higher, the delta increases and then levels off once it gets up towards 100. It also levels off on the downside when it gets close to 0. We're circling those areas there because that's where gamma becomes the least. All of a sudden, the delta stops changing once those deep in the money or deep out of the money designations are reached. The delta just doesn't move anymore, and gamma becomes very small. So gamma is greatest at the money. It's smallest out of the money or deep in the money. What about expiration? Would gamma be greatest closer to expiration or further out in time? I heard closer a lot. Yeah, that's correct. And again, push that question to an extreme. Let's say the stock's at 100 and we're looking at the 100 call option that expires today, and the stock moves to 101. That delta is going to change rapidly. It's going to go from 50 to 70 or 50 to 80 because it's expiring so soon. If we're looking at the same strike price call, but it expires 2 years from now, and the option or the stock price moves $1, the delta is just not going to change very much. So again, it's intuitive, not tough to understand, that the greatest gamma is going to be near term. And that's what we see here. As expiration nears, the gamma of at the money calls and puts increases, and it continues to increase all the way through expiration for at the money options, where in the money and out of the money options decrease in gamma. This is what's known as exploding gamma. You may have heard that term. When you get to expiration day and you're looking at the at-the-money options, if the stock is moving up and down, above and below the strike price, the delta is going to be flipping from 100 to 0. Not exactly all the way there, but very, very high to very low throughout the trading day as the stock moves around a strike price because it's so close to expiration. It's in the money, it's 100 delta. It's out of the money, it's 0. And as those hours pass on expiration day, the delta is changing so fast, the gamma becomes huge, and that's what exploding gamma is, at the money and near term. I want to talk about scalping gamma for a bit, because you may have heard this term before, and it's very interesting to at least walk through. A lot of professional firms will do this, and it was something that my firms did when I was trading for them. There's a lot of information on scalping gamma. It's also known as delta hedging or dynamic hedging. You can look up those terms and find out more about this. But it's the process by which professional traders re-hedge their position to become delta neutral and then continue to re-hedge their position as the stock moves to bring their overall position back to delta neutral all along the way, profiting every time they re-hedge. Let's do this with an example again. And I'm a little out of practice with math, so I hope I get this right. So stock's at 100. Let's say we buy 10 of the 100 strike price call options. It's 50 delta. We buy 10 of them. So we have 500 long deltas right away. In order to be delta neutral there and use stock to be delta neutral, we would sell 500 shares. Agreed? We own 10 calls. That's 500 deltas. We sell 500 shares of stock. We have a delta neutral position. Now let's say the stock goes up to 110, and pushing it to an extreme, let's say the delta of that call went all the way up to 100. We own 10 of the 100 calls with a 100 delta. That's now 1,000 deltas that we have on the calls. We're only short 500 shares of stock. We need to sell another 500 shares of stock to get back to delta neutral. Agreed? So we sell another 500 at 110. Now the stock tanks and goes all the way down to 90. And the option that we have goes to a 0 delta. We have no more deltas on the option. We're short 1,000 shares of stock. We need to re-hedge again to become delta neutral. We buy 1,000 shares at 90. And the last piece, let's say the stock goes back right where it started, back to 100, 50 delta, 500 deltas on the options. So we go ahead and we re-hedge by selling 500 shares of stock right where we started. But what did we do in between? Sold 1,000 shares at 110, bought 1,000 shares at 90. That's profit for us. That is gamma scalping. That is positive gamma working in your favor as the stock moves, re-hedging the position in order to scalp or profit based off of your re-hedge. Now, from a general perspective, this really does make sense as well. If you're long options, you want stock movement. We all know that. When you buy options, we know time is working against us. The erosion of each day is working against us. So we need stock to move. And the process I just described is buying an option and then capitalizing on stock movement. What if the stock didn't move? We'd be losing. Time decay would be working against us. We'd be losing with each passing day. And that's what you expect when you buy options. If you're the seller of options, you want the opposite of movement. You want no movement at all. So while gamma scalping is something option buyers try to do who are remaining with a delta neutral position, sellers of options, if they're delta neutral, are scalping against themselves. Think about that example I just walked through from the other side. The other trading firm that is re-hedging their position as the stock moves, they're the ones that bought high and sold low. They scalped for a loss. Short options, if you're re-hedging, scalp for a loss. And that makes sense too. When you're selling options, you want no movement. So if there is a lot of movement, that's going to cost you in your portfolio. And that's what scalping gamma is.
In fact, if you're selling options, you want no movement. That's only if you're neutral on that on both sides. If you're selling a put, I sell puts all day long. I want the stock going up.
So the question is a good one. If as I'm saying, selling options wants no movement, I am assuming that you're a seller of multiple options. And the question was, well, if I'm selling a put, I really only have one side to be concerned about. I don't mind the stock moving higher. Even if I'm bullish, I might sell a put and the stock moves higher. That's good for me. So you don't necessarily want no movement if you sell a put. Positive movement in the upward direction works out for you. And that's absolutely true. So when I'm saying this, especially from the professional level, selling options is selling multiple options. You could think about it as selling strangles instead. You're selling calls and puts. You're selling options all day long. It's a more general statement. If you're selling both sides, you want neutrality. And those are why we chose that's why we chose the iron condors as our examples, because professional traders are trading a lot of positions, and if they're overall short gamma, short options, they want no movement because inevitably they got short positions all over the place. So it's a good question because if you're making one trade, you may actually have a directional bias. You're comfortable with that move, and you may want that move in the stock to occur even though you're a seller of options. With multiple positions, it can get a little more complicated, and that's what we're trying to focus on here with the Greeks. One more question?
So does that mean that higher volatility is better environment?
So the question is higher volatility a better environment for scalping gamma? I'll say this. If you're long options and you're going delta neutral and you're trying to scalp gamma, a future level of volatility that is higher than today's level would be better for you. You're hoping that in the future you will see more volatility and you will be able to continually re-hedge and go delta neutral. The tricky part with doing this, again, it's a somewhat risk-controlled way to trade, but the tricky part in reality is knowing when to re-hedge. I gave you that example of the stock moving $10. Just think about that in reality. As the stock moves up from 100 to 102 to 104 to 105, at some point you have to re-hedge. You want to let that run in your favor as long as you can, but at some point you have to re-hedge. It's a very difficult decision to make on when do you do that. If you re-hedge too early, you don't capitalize as much. And if you wait too long, you may miss your opportunity as the stock moves around. So it's tougher to implement than you might expect. But it is very interesting to understand how it works. So let's do our knowledge check. And I'm going to walk through the same example, same trade that Jamal did with Delta to see how the gamma translates over. So first of all, we have stock trading 50, and it's fairly close to expiration. If an investor were to buy 5 of the 50 calls and shares increased $1, what would the expected new delta be? So this is the 50 strike, and shares go up by $1. The gamma we're looking at is 12. Gamma is how much do we expect the delta to change as the stock moves $1. So what's the new delta going to be? It is going to be 51 plus 12, or 63. Now that's a pretty big move, but this is consistent. Also notice as we're looking at these, I wanted to exaggerate the numbers. This is pretty close to expiration. So that ties together. A 12-point move in delta for a $1 move is pretty significant, but that makes sense because we're so close to expiration. Next one, if investor was short the 52 calls, stock trading 50, would a share price increase of 2 lead to an increase or decrease in gamma? Go back to what I said in the beginning here. Where is gamma the greatest? Where is it most significant? It is at the money. This option started out of the money, now it's at the money, so it's going to have a greater gamma exposure. It is now an increase because it's at the money. And the last one I want to walk through here is one that has a few pieces to it. This was that dynamic hedging concept I talked about. If a trader was long 10 of the 52 calls, so the 52 calls which have a 29 delta, long 10 of those, and shares increased by $1, how many shares would they need to buy or sell in order to remain delta neutral? So a couple of pieces to this. First, we buy 10 of the 52 calls. What's the delta position? 290. We have 29 deltas on each one that we bought. We bought 10 of them, and now the stock goes up by $1. So what's the new delta position there? 390. So our delta position started out as 290, and we said we did this delta neutral, so 290 and short 290 shares of stock. That's how we started. Stock moved up. Now we have 390 deltas on the options. We're only short 290 shares. We're going to re-hedge by selling 100 more shares. That is that dynamic hedging that I walked through earlier. And now to put all this together and really compare Jamal's discussion on delta, let's look at the example. The same example that we went through before, same trade as before. This is a neutral strategy, the iron condor, selling a call spread above the current level of the stock and selling a put spread below the current level of the stock. First question, what is the gamma of the short call spread? In general, is it long or short? And remember, at the money is greatest. Is it a long or short gamma position? It is short. We sold the 110 calls. That strike price is closer to at the money than the 120s, so it is a short gamma position. What does that mean? That means as the stock moves up, the position gets shorter delta. Opposite correlation. What is the gamma of the short put spread? Stock's at 100, we sell the 90 put and buy the 80 put. Is the gamma long or short? Short. The gamma of the 90 put is going to be dominant over the 80, and that means we are short gamma on the put spread as well. So when you put these two together, obviously, to make the iron condor trade, it is a very short gamma trade. Tying this into the whole idea of doing the iron condor itself, selling options, neutral strategy, looking for little movement, not wanting those deltas to change too much. But what happens if it does? 30 days later, the stock is beginning to test the short call spread. It's moved higher. We didn't want to see that, but it has happened. Has the delta of the short put spread become more positive or more negative? Has the put spread delta become more positive or more negative? Remember, we sold it. It had delta. We sold it. That's a long delta position. Stock moved up. The delta went to 0. So we had long deltas originally. Now we have none. So it went more negative, yes. So long deltas effectively disappeared. Remember, we were delta neutral iron condor. That's what we wanted. No movement, delta neutral. The long deltas were coming from the short put spread. They're gone now. The stock moved up. Has the delta of the short call spread become more positive or negative? Stock moved up. Deltas went which way? Stock went up, we're short gamma. Stock went up, deltas went down. We got more negative on both sides. They're both short gamma. Stock went up, the deltas got negative on both sides. The long deltas we had from the put spread are gone, and the short deltas from the call spread got greater. So now we have exposure on this position. We have exposure on the iron condor that we didn't want to have, and the reason why we have exposure is because the stock moved. The trade didn't work out. Our forecast was incorrect. And here's a quick snapshot just to remind you of what long gamma is versus short gamma. It's correlation. If the stock moves in the same way that the delta is going to move, that's a long gamma position. And if the correlation is opposite, it is short gamma. Buyers of options have long gamma and want movement. Sellers of options in general are short gamma and want little to no movement. wrapping all of that up, delta is the anticipated change or the expected change based on a $1 move in the underlying stock, all else equal, just like all these other Greeks. Can also be used to determine in-the-money probabilities. That can help you select strike prices if you want to use it that way. That's not precise mathematics, but it is used in that context from time to time. Gamma, tied directly to delta, is the anticipated change in the delta as the stock moves. And remember this, gamma is greatest for at-the-money near-term options. That means your delta will be much more sensitive to stock price movements near-term and at the money. And as we wrap it up, there again is our contact information. You find us on our website at optionseducation.org. Contact the investor services team with questions. There's a lot of Greek material on our website. Going to take about a 15-minute break or so and then get back with the start of session 2 on Vega, Theta, and Rho. See you in a little bit.